At the end of 2021, we've paved the road to 2022's G20 presidency, promoting Recover Together, Recover Stronger as its main theme. The first Finance and Central Bank Deputies meeting in the Indonesian presidency has established 6 priority agendas in the finance track that will be discussed throughout 2022. Now, it's time to get the wheels turning. One of the most crucial agenda in the Indonesian presidency is exit strategy to support recovery. COVID-19 has led to a severe global recession. In response, countries have taken unprecedented fiscal and monetary policies to protect the economy. These policies, along with the distribution of COVID-19 vaccines, has brought positive outcomes. Economic activities had begun to resume. Nevertheless, recovery doesn't come as a one-size-fits-all item. Advanced economies are recovering much faster than their emerging markets counterpart, while low-income countries are lagging. The different timings of exit policies can potentially bring negative spillover effect for countries. To mitigate these risks, a well-planned, well-calibrated, and well-communicated exit strategy is needed. Under Indonesia's presidency, the G20 countries and invitees will work together to create policy settings for a smooth exit strategy. Discussions will be held in the working group level as well as high-level meetings. For it is our duty to ensure that emerging from this pandemic, no one gets left behind. Recover together, recover stronger.
Dunia tengah berjuang menghadapi musuh tak kasat mata yang menyentuh seluruh aspek kehidupan. Namun di tengah tantangan, selalu ada secercah harapan. Aktivitas terus berjalan, memutar roda perekonomian. Dalam keadaan ini, seluruh dunia perlu bergerak bersama, mencapai pemulihan bersama.
Bersatu, bersinergi, bergotong royong, membangun optimisme, pemulihan ekonomi.
Indonesia akan memegang presidensi atau tuan rumah KTT G20 pada tahun 2022.
Forum G20 terdiri atas negara-negara terbesar di dunia. Bersama, G20 membentuk 60% populasi bumi, 75% perdagangan global, dan 80% PDB dunia. G20 membahas isu-isu ekonomi seperti pemulihan ekonomi global, sektor keuangan, ekonomi dan keuangan inklusif, serta ekonomi digital, dan isu lainnya seperti lingkungan hidup, kesehatan, ketenaga kerjaan. Setiap tahun, presidensi G20 dipegang oleh salah satu negara anggota yang memiliki andil dalam menentukan topik pembahasan forum. Dan pada 2022, presidensi G20 dijabat oleh Indonesia. Dengan keadaan dunia yang masih terdampak pandemi, presidensi G20 memberi kekuatan Indonesia untuk menjadi bagian penting dari pemulihan dunia sekaligus mendorong pemulihan dalam negeri. Kelancaran presidensi memerlukan peran kita semua, mulai penyusunan materi, penyiapan sarana prasarana, komunikasi, hingga berbagai aspek lainnya. Dukung kesuksesan presidensi G20 2022 jadi bagian dari momentum penting perekonomian global. Indonesia saatnya pimpin pemulihan dunia.
At the end of 2021, we've paved the road to 2022's G20 presidency, promoting Recover Together, Recover Stronger as its main theme. The first Finance and Central Bank Deputies meeting in the Indonesian presidency has established 6 priority agendas in the finance track that will be discussed throughout 2022. Now, it's time to get the wheels turning. One of the most crucial agenda in the Indonesian presidency is exit strategy to support recovery. COVID-19 has led to a severe global recession. In response, countries have taken unprecedented fiscal and monetary policies to protect the economy. These policies, along with the distribution of COVID-19 vaccines, has brought positive outcomes. Economic activities had begun to resume. Nevertheless, recovery doesn't come as a one-size-fits-all item. Advanced economies are recovering much faster than their emerging markets counterpart, while low-income countries are lagging. The different timings of exit policies can potentially bring negative spillover effect for countries. To mitigate these risks, a well-planned, well-calibrated, and well-communicated exit strategy is needed. Under Indonesia's presidency, the G20 countries and invitees will work together to create
Assalamualaikum warahmatullahi wabarakatuh. Ladies and gentlemen, a very good morning from Nusa Dua, Bali. Welcome back to the third day of Bank Indonesia Annual Investment Forum 2022. My name is Artha, and I will be your host for today. We hope everyone is well and found all the session informative and valuable thus far. Before we begin, let us spare a moment of silence to wish for the success of this event and take this as a moment to wish everyone well in this unprecedented time. The moment of silence begin. Thank you. We would also like to extend a very warm welcome to Assistant Governor of Bank Indonesia, Head of Departments of Bank Indonesia, Mr. Rudi Huta Barat, Head of Reserve Management Department, and last but not least, a very good morning and a very warm welcome to all distinguished guests and participants. Ladies and gentlemen, today we will have an international seminar on exit strategy with a theme anticipating the impact of global central bank exit strategy on emerging markets capital flow. To begin with, allow us to invite Mr. Rudi Huta Barat, Head of Bank Indonesia's Reserve Management Department, to give the opening remarks. So without any further ado, please welcome Mr. Rudi Huta Barat.
Assalamualaikum warahmatullahi wabarakatuh. Salam, Om Swastiastu, Namo Buddhaya, Salam Kebajikan. Our esteemed speaker, Mr. Ilyok Sim, Head of Economics and Financial Market for Asia Pacific, Bank for International Settlement. Mr. Andre De Silva, Head of Global EM Rates Research ASBC, and moderator, Mr. Tommy Chokro. Distinguished guests and participants, ladies and gentlemen. Good morning. I hope all of you are blessed with well health and prosperity wherever you are. It is great honor for me to have and welcome you to International Seminar on Exit Strategy of Bank Indonesia Annual Investment Forum 2022. As a side event G20 Presidency of Indonesia 2022. Hence, this event is very important to build optimism toward continued global economic recovery in 2022. On this occasion, please allow me to sincerely express my gratitude to our prominent speaker from BIS and HSBC for making our event become more special. I would like to thank participants from my fellow central banks, our strategic partner from investment bank, asset manager, and Indonesian banking industry, and related department in Bank Indonesia. Also, Bank Indonesia rep office in New York, London, Singapore, Tokyo, and Beijing, and colleagues from Bank Indonesia Pension Fund and Foundation for taking your time to attend this seminar today, as well as my colleague in the Reserve Management Department to make this event possible. Ladies and gentlemen, we have witnessed that the COVID-19 pandemic triggered extraordinary stimulus in the last 2 years in both developed and emerging markets. The well-orchestrated fiscal and monetary stimulus has contained the economic deterioration due to the pandemic and boosted the economic recovery. In line with the increased vaccination coverage worldwide, the world economy has gradually experienced positive growth in 2021. Several major countries have begun to reduce their monetary stimulus in line with better demand amid supply chain disruption, which started to drive inflationary pressure. The normalization of monetary policy, especially by major central banks, will certainly have a broad impact on global financial market. We have seen the impact of Fed's policy normalization process in 2013, in particular on economy of emerging market countries. Distinguished guests and participants, ladies and gentlemen, many leading economics predicts that the normalization nowadays would have the same taper tantrum effect in 2013. This is due to better authorities' communication in providing policy signal, and the current economics and financial position is better than 2013. The theme of this seminar on exit strategy is relevant as we will face the potential of monetary policy divergence between central banks, along with the differences in the speed of the post-pandemic recovery process. Some countries rebounded faster than others, thus creating divergence in economic development and policy responses. While the normalization of major central banks is expected to be milder than 2013 taper tantrum, the divergence in policy response could still possibly increase volatility and uncertainty in financial market and could lead to significant challenge to economic recovery and financial stability in emerging market countries. Therefore, it is important to discuss policy setting for smooth economic strategy, noting different conditions across country, and discuss how to strengthen global risk monitoring and how to mitigate negative spillover. This seminar will be a half-day event with the topic anticipating the impact of global central bank exit strategy on emerging markets capital flows. Today, we are lucky to have prominent speaker, Mr. Ilyok Sim from BIS, who will share with us his latest finding about the strength emerging market economies, and Mr. Andre De Silva from HSBC. He is an expert in emerging market research. Mr. De Silva will present market views on the readiness on emerging market countries in facing normalization. Distinguished guests and ladies participants and gentlemen, I believe today's seminar will enlighten one of the most important agenda in G20, which is how to synchronize unsynchronized world to ensure recover stronger and recover together. Please stay healthy and wishing you happy Chinese New Year, and for colleagues who celebrated, thank you very much. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you, Mr. Rudi Utabarat. Before we move on, we would like to invite all participants to join the photo session. We might have to do 2 takes. To all participants joining us online, kindly turn your camera on and give your best smile. All right, let us prepare to take pictures. On my count, 3, 2, 1. Let us take pictures once again. On my count, 3, 2, 1. Thank you very much. Before we proceed to the next session, we would like to invite you to enjoy a video about G20 that we have prepared specially for you.
At the end of 2021, we've paved the road to 2022's G20 presidency, promoting Recover Together, Recover Stronger as its main theme. The first Finance and Central Bank Deputies meeting in the Indonesian presidency has established 6 priority agendas in the finance track that will be discussed throughout 2022. Now, it's time to get the wheels turning. One of the most crucial agenda in the Indonesian presidency is exit strategy to support recovery. COVID-19 has led to a severe global recession. In response, countries have taken unprecedented fiscal and monetary policies to protect the economy. These policies, along with the distribution of COVID-19 vaccines, has brought positive outcomes. Economic activities had begun to resume. Nevertheless, recovery doesn't come as a one-size-fits-all item. Advanced economies are recovering much faster than their emerging markets counterpart, while low-income countries are lagging. The different timings of exit policies can potentially bring negative spillover effect for countries. To mitigate these risks, a well-planned, well-calibrated, and well-communicated exit strategy is needed. Under Indonesia's presidency, the G20 countries and invitees will work together to create policy settings for a smooth exit strategy. Discussions will be held in the working group level as well as high-level meetings. For it is our duty to ensure that emerging from this pandemic, no one gets left behind. Recover together, recover stronger.
Dear participants, as we are about to start the seminar, we would like to invite Mr. Tommy Chokro, Chief of Content at Badiku, to lead the discussion. Tommy Chokro is the Chief of Content at Badiku. He is also the lead anchor of one of the biggest TV stations in Indonesia. As an entrepreneur, he is the co-founder of Sepikul Indonesia Communication and Fabric. He became a moderator for 2019 Indonesia presidential election debate and also for 2018 Central Java regional election debate. So without any further ado, please welcome Mr. Tommy Chokro.
Greetings, thank you, Mr. Ima Dearta Segara for the introduction, and also thank you to Mr. Rudi Utabarat, Head of Reserve Management Department, Bank Indonesia. Hello everybody, good morning and welcome to Bank Indonesia Annual Investment Forum 2022, Searching Values for Managing Reserves in Multipolar World. The global economy enters 2022 in a challenging position. As the new Omicron COVID-19 variant spreads, countries have reimposed mobility restrictions. The global economy got also challenged by rising energy prices and persistent supply disruption. But in other perspective, it is very encouraging that the rate of vaccination in emerging markets has seen a marked acceleration, even if Omicron may yet pose a risk. And this has helped support economic growth. National economic growth in Indonesia in 2022 driven by ongoing global economic improvement that are driving solid export performance, added with growing domestic demand in terms of consumption and investment. So this is supported by a faster vaccination rollout, reopening of economic sectors and policy stimuli, and close policy synergy and economic performance in 2021 represent capital to rise and be optimistic concerning a stronger national economic recovery in 2022. So as advanced economists lift policy rates, risks to financial stability and emerging market and developing economies' capital flows, currencies, and fiscal position, especially with debt level having increased significantly in the past 2 years, may emerge. Advanced economies and emerging markets define their policy rates in order to withdraw from the quantitative easing will influence the spillover and spillback in the global market. Emerging markets have demonstrated unconventional strategies in dealing with capital flow volatility, and it is key to communicate well the policy transition towards a tightening stance to ensure orderly market reaction. Hopefully, the policy mix remain synergized as part of the national economic policy direction to accelerate recovery while maintaining economic stability. Again, allow me to introduce myself. I'm Tommy Chokro. It's an honor to be here as a moderator for this presentation by two great speakers today. So with the topic of anticipating the impact of global central bank exit strategy on emerging markets capital flows, it is time to get insights, knowledge, and initiatives in this great Saturday morning. We will get several points of view such as initiative in capital flow and foreign reserve management, and also how far the coordination and collaboration role of G20 countries in assisting the recoveries. So we will get the insights from first, Mr. Il-Yok Sim, Head of Economic and Financial Markets for Asia and the Pacific Monetary and Economic Department of Bank for International Settlements, or BIS, and Mr. Andre De Silva, Head of the Global Emerging Markets Rates Research at HSBC. Mr. Sim is Head of Economics and Financial Markets for Asia Pacific at the BIS. He joined the BIS in Basel in 2004 as economist. In 2007 until 2018, he worked at the BIS in Hong Kong as principal economist and at the BIS in Basel as special advisor on international financial stability policy. In 1997 to 1999, he worked at Korea Ministry of Finance and Economy as deputy director in charge of deposit insurance and financial sector restructuring. And in 2010, he was advisor to the G20 Affairs Office of the Bank of Korea. He received a PhD in economics from Stanford University and an MA and a BA in economics from Seoul National University. Focusing on the impact of advanced economy central banks exit from accommodative monetary policy on capital flows to emerging markets and emerging market central banks and other financial authorities' role in facing advanced economic central bank exit. Ladies and gentlemen, let's welcome Mr. Il-Yok Sim. Mr. Sim, the time is yours.
Okay, thank you, Chair, for your kind introduction. And while I'm waiting for the slides to be uploaded, I'd like to thank the Bank Indonesia organizers for inviting me to this event. It was, I think it's a great timing in terms of topic and also the importance. Okay. So before I start, let me just emphasize that the presentation today is my own view, not necessarily the view of the BIS. So my presentation will have two parts. Next slide, please. The first part, I'm going to go over some of the conceptual and empirical aspects of the impact domestic and central bank policy exit on capital flows to EME. And then second part, I'm going to discuss briefly about what we can call policy implications. So let me start from the next slide, please. Let me start from domestic and monetary policy and capital flows EME. So when we talk about the domestic and monetary policy spilling over to EMEs, we can think about both the short end of the yield curve and also the long end of the yield curve. So policy rate by central banks in other economies or asset purchases. And one of the main risks to EMEs from those policy exit are indeed capital outflows, excessive exchange rate volatility. And in terms of the channel, we can think about two channels conceptually. One is interest rate, and the other one is exchange rate. And here, there are actually so many different dimensions that this domestic economy policy can affect EME. So in my presentation, I'll try to cover as many ground as possible on that. But conceptually, we can think about the dollar borrowing by emerging market, what we can call original sin, and also local currency borrowing from foreign investor, I can call the original sin detox. I'll come back to that later. And policy rate hikes and also the tapering or even reversing the asset purchases by the US and other Mexican central banks will result in narrowing interest rate differentials in both short and long ends of the yield curve. And that can have direct impact on capital flow. Next slide, please. So just quickly going over, many of you remember that in the late 19th, we had several Asian crises, financial crises like in Asia, in America, other places, and that involved sudden stop of international banks lending to EMEs in US dollars. So the focus was the banks playing a major role, and most lending was in US dollars. But since then, many EMEs, they have learned the lesson. They tried to increase the role of the bond market and also local currency. But still, in many EMEs, both the external bond financing in domestic currency, local currency, and also foreign currency borrowing coexist. So this original sin concept, 1999, this famous paper by Green and Hausman, so it mentions that this economy, EME, not being able to borrow in the domestic currency for various reasons. And that's driven by currency mismatch on the borrowers, the EM borrowers balance sheet. The EM borrows income or asset in domestic currency, but the liability is in US dollar. And that's still relevant for foreign currency bonds issued by EMEs, especially corporates nowadays. And then the second one, original sin redux, is a concept put forth by Austin Carsten and Jean Song-Shin, both at the BIS. So this one focuses on the currency mismatch on foreign investors or lenders' balance sheet. You can imagine the foreign investors, those ultimate investors, US dollar-based investors, but they invest in EM assets, EM bonds or EM equities. So there is currency mismatch on their balance sheet, not necessarily the borrower's balance sheet. Next slide, please. So this shows the movement of 5-year government bond yield in different countries. You can see the black line, which is for the US Treasury, and other EM bond yield, long-term yield, tends to move together. And you can see some sort of large spikes, such as hypertension 2013, and also the early sort of stage of the COVID crisis in March 2020. Next slide, please. So when you zoom in for the past 2 or 3 years, you can clearly see that the gold movement has been quite strong. And especially I'd like to mention that about this time last year, we have seen a relatively large increase in US long-term yield and also affected other EMEs long-term yield. Next slide, please. So let me just look at this, I would say, core movement of the US and EME bond yields in a more analytical way. So I ran some panel regressions, 20 EMEs, and here, for the past 10 years or so, I want to see what's the impact of the 1 percentage point increase in US 5-year bond yield and also US Fed funds rate on EMEs, so bond flows, EMEs, capital flows. And you can see that when the US long-term or short-term rates increase, the bond flow decrease. And you can also see that the Fed funds rate, the same size of the change, has bigger impact. And the lower part of the panel of the table basically shows that what's the impact of those US long-term, short-term rate changes on the EME's 5-year bond yield. You can see that there's roughly between 20 to 30 basis point impact, depending on whether you include some variables as control or not. So 1 percentage point change in US rates roughly corresponds to 20-30 basis points over this period. Next slide, please. Actually, my most recent sort of research and also BIS, we have focused a lot on the role of exchange rate. As you all know, the exchange rate is a sort of endogenous variable. It sort of reflects all kinds of information and policy actions and so on. But at the same time, exchange rate works as an amplifying mechanism, meaning whenever exchange rate moves, that tends to affect many different markets, capital flows, and also it sort of generates what we can call the feedback mechanism, meaning exchange rate affects the market price affects flow, and then it comes back to exchange rate, and then that sort of loop continues. It's very important to understand the role of exchange rate. And central banks, especially in Asia, are making a lot of effort to understand why exchange is so volatile, how can you improve the FX market, and other aspects. So this exchange rate is very much central to analysis at the moment in the BIS. And we all know that whenever the domestic economies change interest rate, that tends to be accompanied by the currency depreciation at the current juncture. And there's again two channels, roughly speaking, we can think about the exchange rate movement. When the EME currency depreciates against US dollar, and that prompts the US dollar-based investors to reduce their investment in US dollar to EMEs. It's correspondence original sin. And then we can also think about for investors who are investing in local currency assets like bonds or equities in EM, they are also likely to withdraw the investment because they also have this currency mismatch. And more recently, during the COVID, it became quite clear that the growth differentials, I would say synchronization or unsynchronization, is an important aspect, especially pandemic situations, generating additional source of capital flows. Next slide, please. So now let me go through a few tables showing the results. So here the main message is what's the impact of the EME currency appreciation on capital flows. So there are two kinds of capital flows I'm going to consider. One is what we call the bond fund flows, and the mutual funds investing in EMEs, bonds. And then I'm also to think about the BOP style, in all kinds of bond investors flows in and out. So first, the EPFR data, we can again see that when the EME currency appreciate, that generates more inflows. And here, I like to highlight the difference between the broad US dollar index, which is on the left-hand part in each panel, and then the bilateral exchange rate. So here, the US dollar index is basically capturing the global risk appetite, I would say, because this index is the strength of the US dollar against its trade counterparts. Different rates applied. And by contrast, this bilateral exchange rate of EM currency against US dollar is sort of driven by both the global factor, potentially US factor, and also EM factor, local factor. So they're actually capturing slightly different aspects of exchange rate. And here you can see that the coefficients on these relations for dollar index is much larger throughout any different period and different frequency. And also you can see that the weekly data, the impact is slightly smaller. That's because the impact of exchange rate tends to sort of trickle down over time. So monthly one is bigger, efficient. Next slide, please. And we can do the same exercise for the IIF data. So counterpart to BOP data, they have daily, weekly, and monthly data, basically same message. They have the more stronger impact of the US dollar index compared to the dollar exchange rate, and also the longer the time horizon and the bigger the flow. Next slide, please. And now, as I mentioned at the beginning, quite often the exchange rate is sort of endogenous variable, so it's very difficult to tell how much is endogenous movement. So what I did in my recent papers is we look at the change of exchange rate on the days when the US Fed, ECB, or Bank of Japan, or the bank economists make the policy announcement. We only focusing on those days. We forget about the other days. And as you see here, the impact is much larger when you focus on those days, especially when the Fed makes an announcement. Next slide, please. And now looking at a little bit more country-specific information. Also, so far we have seen the flows, I would say, but then the flows are in dollars, and there's sort of a valuation or exchange rate effect. So I want to sort of take out all the valuation effect, exchange rate, and also local currency bond price change effect. So the sort of a truly net concept of buying and selling by bond funds. So that's the measure for bond purchase here. And again, same exercise, we see the impact of 1% appreciation of the dollar to EME bond purchase by bond funds. If the left-hand panel is showing the local currency bond funds, right-hand panel is US dollar bond funds. And the same metric. So here the values on the axis basically show that how much these bond funds change the allocation in terms of percent to each country. So if it's like minus 0.10, that means 10 basis point decline in the country's share in the bond funds investment in the all EMEs. And you can see that there's some cross-country difference, but overall the dollar index is much stronger impact than bilateral exchange rate, and also the foreign currency bond purchase, they tend to be more affected than compared to the local currency bond purchase. Next slide, please. And so far I was focusing on bond market, but equally important, especially some economies, is the equity market. And there has been much less research on the equity market, but what we can see here, so same story holds. Whenever the dollar index appreciates, dollar gets stronger, we see equity outflows from EM, and also EM stock market returns going down. And that's true for both CPFR and IIF data. Next slide, please. So what I haven't covered so far are two aspects, COVID and banks. So the left-hand panel shows the red line, especially shows the cross-border bank lending to EMEs, and you can see the black line, which is the dollar index, and the red line moves in opposite directions over time. So dollar lending to EMEs are also affected by the global financial conditions or strength of the dollar. And the right-hand panel basically shows the capital flows in both corporate and government bond funds in local and foreign currency. You can see the strong patterns of co-movement. So even corporate borrowing in EMEs in both US dollar and local currency also similarly affected. Next slide, please. And so far I was focusing on flows. Now I'm talking about prices for EME domestic long-term bond yield, bond spread. And that's important because EME bond spreads are often a very good measure of the domestic financial conditions. And another important aspect, which is I'm not going to cover very much here, is the commodity exporting EMEs. Because quite often commodity price cycles are also in sync with what we can call global financial cycle, or even dollar cycle. So here, to the extent that the commodity sort of cycle are synchronized with the dollar, and then some that kind of EMEs, commodity exporting EMEs, may be in a bigger trouble because that's sort of our menu situation. Next slide, please. Let me show you some empirical findings on the impact of the exchange rate, dollar exchange rate or exchange rate shocks on EM local currency bond spread. The spread meaning compared to the US Treasury. So here you can see that the impact of the 1% appreciation of EM local currency plus the impact on the EM's government bond spread. You can see that there's a negative impact, and the same story here. Generally speaking, we have the dollar index has appreciated. Okay, dollar index change has bigger impact, and that especially when we focus on the announcement days of the Fed or ECB, Bank of Japan policy. Next slide, please. And so far, I was basically looking at the sort of past 10 years altogether, or only focusing on the recent COVID crisis in 2020. Or more generally, we can think about the past 10 years, for example, in 3 different phases: normal times, strong capital inflow time, and strong capital outflow time. For different countries, different timing. And we can conduct the same exercise on different 3 phases. The upper panel basically shows that when you think about the normal time versus strong capital inflow time, they're more or less same in terms of sensitivity to exchange rate and EM local currency bond spread, but you see much bigger bar on the strong capital outflow period. That means the sensitivity increases during the stress time, which is what many Asian central banks and EM central banks actually have also agreed. And just drawing in further, we can think about the 3 different sort of stress periods in the past 10 years, GFC, and September 2015, I think there was emerging market, so there was a bit of turmoil, and more recently COVID-19. And what's interesting is the COVID-19 period has much lower sensitivity to the previous sort of stress period. And this can be explained for many different ways. But one important way is this time COVID-19, many EM central banks were actually able to lower the interest rate this time. And also they had much stronger fundamentals. Even though they had suffered some capital outflows, they were able to quickly come back. So I would say the resilience of EM central bank, EM's overall has improved. And that sort of shows here as low impact of the exchange rate appreciation on EM local currency bond spread. Next slide, please. And the same story goes for the corporate bond yield. And the right-hand panel basically shows that when you compare the same sort of impact of exchange rate appreciation on corporate versus government bond spread, then corporate bond spread tends to react more strongly. Next slide, please. And this one basically shows that we have a bit of a cross-country difference in terms of the local currency, foreign currency, government versus corporate difference, but they are all pointing to very similar stories. And of course, we have some exceptions here and there, but overall, we have very consistent stories. So this financial channel, what I can call financial channel exchange rate, the impact of exchange rate on financing in terms of flows and prices, very much true for different asset classes, different borrowers. Next slide, please. So just to complete, equity market again. Now we can think about the impact of this exchange rate on the EM equity returns. And this chart shows that over time there's some sort of up and down, but the sensitivity of the EM stock returns to swings in the broad dollar index is quite clear. And this is quite similar to what we can expect from the bond returns. Next slide, please. Now I'm quickly moving to the second part. So what can central banks do, has been doing when they face this advanced economic policy? Next slide, please. So it's crucial from the previous discussion. You can see that for EMEs to monitor FX asset price developments and also signs of funding strains. and commodity price cycle, when especially other economy, central banks try to exit the monetary policy stimulus. And during the period of domestic monetary policy tightening, the EMEs with stronger fundamentals, they tend to face smaller capital outflows or even capital inflows than those with the weak fundamentals. And EMEs have built buffers and also developed the resilience in the financial system using various policy tools. So if those economies, they have resilience before domestic policy exit comes in, then they're likely to perform better. And compared to taper tantrum in 2013, most emerging Asian economies now have much better fundamentals, and also institutional strengths, such as the credibility of central bank and inflation expectation anchoring. So these kind of things will help those EM central banks weather the tightening global financial conditions going forward. And EM financial authorities have actually used many different policy tools, but you can call policy mix, to maintain domestic and external financial stability. And let me just move on to the next slide to show some examples. So here the chart, any bars pointing upward mean tightening, and any bars pointing downward is policy loosening. So if those bars move together, then that means there's a coordination across policy. So here the red ones showing the policy rate change, the blue ones macroprudential policy, and yellow ones FX intervention. And you can see that in most period times over the past like 20 years, you can see that those bars tend to move up and down together, meaning there has been more or less coordinated policy choices in EMs in terms of monetary macroprudential FX intervention. And the last, the bottom panel basically shows that the co-movement of capital flows exchange rate. The global financial conditions tend to drive the capital flows to EMs. And those policy actions are reacting to those cycles. Next slide, please. So this will be my final slide. So here the main point is when you focus on the COVID pandemic period, 2020 and month by month. And what's interesting and what I also wanted to highlight here is that again, the convention is the same. Any bars pointing downward, meaning loosening, any bars pointing upward. But here, tightening. But here I actually look at many different what we can call additional policy tools introduced, regulatory requirements, central bank asset purchase, and so on, and FX intervention. And here the interesting one is April and May 2020. You can see that March was sort of a crisis time. All the policy actions were going toward loosening. So as you see in the bottom panel, as soon as capital flows switches from outflows to inflows in April and May 2020, we see FX intervention is also following suit. The FX intervention was sort of a tightening side. At the same time, other policy tools were trying to be more accommodative because the macro situation was not that great by the time. So this chart basically illustrates a potential challenge for EM central banks coming from different frequencies of cycle. Meaning, as you all know, FX exchange rate or capital flow tends to be quite volatile and moves in a very high frequency. But business cycle or other financial cycles, credit cycles, they tend to be very slow. So that kind of different cycles pose a lot of challenges to the central banks when they think about this different policy mix at a point in time. Okay, let me stop here. Thank you.
Thank you, Mr. Sim. So before we go to the next presentation, we would like to invite all participants. You can ask questions to the chat box. And later on, after the second presentation, we will invite two participants to ask directly or virtually to the two speakers. And if we still have more time, we can actually select several questions from the chat box. Again, thank you. So now we go on to the next one. So before we start, allow me to read the next speaker's profile. Mr. Andre De Silva, Head of Global Emerging Market Rates Research at HSBC. Andre De Silva is the head of Global Emerging Market Rates Research at HSBC and is based in Hong Kong. His experience spans credit strategy, portfolio analysis, quantitative techniques, asset allocation, global rates strategy, and since 2014, emerging market rates research. The team has been ranked #1 for emerging market sovereign in the Euromoney survey over 4 consecutive years. De Silva has a master's degree in financial economics from Cambridge University and is a CFA charter holder. He is also a qualified technical analyst, MSTA. So now, ladies and gentlemen, with the focus on anticipating the impact of global central bank exit strategy on emerging markets capital flows, please welcome Mr. Andre De Silva.
Thank you very much. I'm particularly pleased to be here, albeit in a virtual capacity, and surrounded by distinguished officials from the Bank of Indonesia and, of course, other guests, and in particular in this forum following after Mr. Sim, and thank you for those kind introductions, Tommy. But I did actually have the privilege of physically being present and speak at the same forum, albeit in Bali, in January 2020. That was just when the pandemic was breaking out, and it certainly was interesting times, to say the least. Now, my responsibility is research. So, of course, I analyze these things. I also look at risk, and I was the only one going to the forum, traveling from Hong Kong to Bali, wearing a mask. And on my return, a majority were wearing masks. And of course, we know what's happened since in 2 years' time. But incredibly, the pandemic continues to grip markets, economies, and there still are repercussions, which we will discuss a little bit, but more in the format of central bank exiting. So now let's turn to the theme, in particular this session of the forum, about exiting of central banks. And main focus, it's not the only one, is about the Federal Reserve. And the slides will come up shortly, but I think we also need to look at it in context of all risk asset classes, not just about EM. And you'll find as I go through some of these slides that it's also a case of there are some distinct differences. And in particular, when we look at the prospects of the Fed balance sheet shrinkage and the series of Fed hikes, there's a lot of concern whether it be shock and awe. And in particular, the focus will be on March. If there's any questions on this a little bit later, happy to answer. But very briefly, expectations are for broader consensus, including from HSBC, that there'll be a lift-off of Fed funds come March, that's mid-March, and there'll be a series of rate rises and also planning to shrink the balance sheet, which has some repercussions for some risk asset classes. For others, as I'll explain a little bit later, there's a lot of preparation, and in particular in EM local debt. And we'll drill down into individual countries if I have time to, in particular likes of Indonesia. But let's now go more specifically to a more broader picture. So to me, I think that weather patterns is also important. When you get heavy rainfalls, and the heavy rainfalls could be this form of Fed balance sheet shrinkage and rate hikes, but with heavy rainfalls, you can get glimmers of sunshine. And with weather patterns of rainfall and sunshine, you can get a rainbow. So I'll conclude later, and I do think there are some optimism for a rainbow for EM local debt. So it's not always stormy conditions just because we're in a period of uncertainty and central bank exiting. But now let's turn to the next slide. In particular, what I'm looking here is the fund flows on all broader asset classes. I say all, but at least a good sample of asset classes since really the pandemic outbreak. And to me, there's quite a lot of defining points, in particular between February or March and April was when we had what I call the market dislocation as a response to the early stages of the pandemic, just when I was traveling back from Bali. And you can see quite significant outflows in the first quadrant in terms of major asset classes, whether it be EM local debt, whether it be EM external debt, which is dollar denominated largely, sovereign debt, and then also EM equities, and also US equities and investment grade and high yield. So anything below the line saw outflows. And that was a broad brush across most markets. But I think we need to think about what's happened since. Where has there been a replenishing of flows, or indeed multiple of flows since? And those that have become more vulnerable as a consequence of central bank exiting, and those are actually better prepared. And you can see immediately, hopefully, in particular last year, so the middle quadrant, you can see key flows coming back into what we call US IG. And then in this last year, both equities, both the light grey and dark greys, both US IG and equities in the US were the key vehicles for getting the flows coming back. But it wasn't just a recovery of the flows that we saw in terms of Q1 of 2020, but multiple of flows returning. And it's staggering when you look at it. For example, let's look at US IG. So since the outflows in the early stage of the pandemic, US investment grade, there was nearly 50 billion outflows in that period, the early stages. And then it's 10 times the amount that's returned, i.e. 500 billion, as a consequence of all these central bank measures. And I say all, yes, the focal point is the Federal Reserve, but it's also other central banks, including G3, G7, G10, and also emerging markets. And so there's a flood of capital washing through the system, and rightly so, in response to an unprecedented, or at least once in almost a millennium or 100 years, in terms of crisis surrounding a pandemic. But in US equities, it's even more staggering. So the amount of flows that returned, 86 times the amount of outflows we saw early stage of the pandemic. So you already begin to pick the puzzle, or in terms of completing it, suggesting that there are other asset classes that benefited much more in terms of the liquidity injection result of the central bank QE and easing than some other asset classes. In particular, what we're going to focus on is EM. So when we look a little bit more in terms of the red bars, and in particular, the bright red bars is local debt, so there's local denominated currency debt, and the lighter red is also external debt. You see, yes, there has been a return of flows, but nowhere near the amount, not only in absolute terms, because it's difficult to compare like for like, but in terms of multiples. So in the case of EM bond flows, yes, external debt, we saw flows, but in particular equities. So if there's something that resonates relative to the US, where there's US equities saw key inflows, EM did. So we saw 5 times the amount of flows return relative to the outflows in Q1 of 2020. But when you look at the external debt, which is again much more conservative, it dwindles down to about just less than 2 times. And then more importantly, something that we'll drill down a lot more specifically a little bit later, when it comes to local debt, actually, we haven't replenished all the outflows that we saw at the early stages between March and April of 2020. To be precise, and this is using the EPFR data, we saw $28 billion outflows during that period. And since then, we've just got up to the mark of 90% return of those flows, not even fully covering, unlike the multiples, in particular, US equities and US IGs. I take this as a positive rather than a negative relative to positioning going into a tightening stage in terms of the Federal Reserve. So now let's go to another way of looking at more specifically. Let's go to more in EM and turn to the next slide, please. So this is now delving into a little bit more detail, and we can see again another sort of differentiation between the asset classes within EM. So if you remember back, yes, US equities was a key recipient of flows. Spread products, US IG was the key recipient of flows. Well, within the EM context and lens, equities too have responded. And you can see this in terms of the trough and the top line, the recovery in terms of EM equities, but nowhere near the same in terms of external debt. So this gives you a little bit more visual line to what I was saying earlier about those multiples. So yes, external debt, which in my mind is a little bit what we call spread products, in similar in terms of credit rather than local debt. And we have seen some flows return, and that's the gray line in between. But have a look at the bottom line, the deep red, that's EM local debt. It troughed in the early stages of 2020, and it's recovered a little bit, but it's just treading water. So to me, all the flush liquidity we saw in 2020, 21 really hasn't been targeted to EM. Yes, we'll look at it a bit later. There has been some differentiation. Some countries have benefited to a certain degree, but on aggregate, that has not been the case. So as we had in terms of one of the esteemed speakers at the very beginning, talking about the backdrop about this is not a rerun of 2013, I completely agree with that. We're no longer in the same position where there was significant overweight positions in terms of international ownership, type of ownership being more retail than institutional. This is very different. But I would also stretch a little bit another analogy, also what I call QT, so quantitative tightening. We also have a precedent, and that is in 2018. I also make the case we're not also back to the periods then where also EM was vulnerable. And I think the best way to describe that is going to the next slide, in terms of looking at returns. So you quite often find, and unfortunately it's human nature, it's either chasing returns. Whenever there's positive returns in markets, you'll find a flood of money coming in. Maybe it's more to do with retail rather than institutional, but that typically is the case when it comes to EM. And when Mr. Sim talks about flow of funds, etc., I've done some analysis too on that, and you see that whenever you get negative returns, there's a concentration of cash management and additional liquidation of bond holdings when there's on the negative returns. So when there's following the door out in terms of flow of funds, and that certainly was the case in previous periods of stress. So in particular, in 2013, again, this looks at the key asset classes in terms of returns, so total returns of EM local debt, EM external debt, and equity. And you saw in 2013 negative returns, but I wanted to focus more recently, and in particular last year, you already had significant negative returns in EM as an asset class, whether it be EM local debt down nearly 80% over the course of last year, whether it be EM external debt, a little bit more conservative because it's dollar denominated, it was just shy of 2% down. EM equities was down 2.3%. The last time we had that sort of complexion was, lo and behold, in 2018, which was the main rump of quantitative tightening, which actually occurred in September 17 and finished in October 19, but the main market impact was in 2018. So to me, the return characteristics are very reminiscent of QT in the previous period of QT in 2018, and we already had the stress tests also in 2013. So to me, this sort of negative returns, the flow of funds following the door out has already materialized in preparation, even if it's different circumstances, already in preparation to the Fed tightening and other policy normalization by central banks. And then to me, the next slide, please, but I think that it's also important to talk about central bank balance sheet generally on an aggregate. So we have seen this flood of money coming in particular, and this is looking at the G3, so namely the Federal Reserve, ECB, and Bank of Japan. Of course, you could add a wider remit, you can do other central banks too, but these are certainly the most sizable, or one of the most sizable balance sheets in terms of expansion we've seen in history. And in particular, we saw the Fed balance sheet balloon. The current juncture, it's 8.9 trillion. That's more than twice the prevailing level prior to the pandemic, which was circa around 4.2 trillion. And also other central bank balance sheets were expanding very rapidly. And as we saw earlier, was targeted very much into various asset classes in terms of risk asset classes, predominantly DM rather than EM. So what about the other side of the coin? What's going to happen when we are likely and going to get some shrinkage in the balance sheet? So if you look at the next slide, we can see the link between, this is now specifically EM asset classes, EM equities and EM bonds, to the balance sheet of those G3. And you can see the evolution of the peaks and troughs when it comes to the global liquidity measures. And we're already, in terms of the pace, even we're yet to see shrinkage of the balance sheet, the pace of growth on an annual basis, so that black line is the pace of growth, annual growth of balance sheets that are already declining because the Fed is purchasing less, Bank of Japan is purchasing less, ECB is purchasing less. Yes, it's QE, but it's less than it was before. And of course, if we extrapolate that further, there'll be absolute balance sheet shrinkage. But I would say certainly it's other asset classes that will see a lot more impact. And if there is within the lens of EM, it's more likely to be equities than it is going to be fixed income, in particular local debt, given the preparation. Now, going back to that analogy I said earlier about the rainbow, and don't cite me on all these 7 colors, but I would say that I can mention it, but what are the factors equivalent to that? Well, what gives us optimism of some of the sunshine and hence the rainbow? Well, it's not just about positioning. It's also, as you'll hear later from me, it's also about real yields. So 2 key markets going into this year, our official and public view by myself and my team, key markets standing out for us is South Africa and Indonesia. This is much better in terms of preparation going into this so-called cycle than other elements. So to me, there's this factor. The other one is also foreign exchange. Let's look at year to date. One would have thought with the balance sheet shrinkage and expectations that there would be sharp currency weakness in the EM. That hasn't happened. That's just suggesting that the carry components, the real yield components, has already providing some sort of cushion, and there already has been outflows last year. So anticipating another wave of outflows is unlikely. But again, I'll piece that a little bit later. So let's now move more specifically to where I think EM is much more better prepared. If we go to the next slide, please. So in contrast to previous periods, QT, as in 2018, the main rump of the market adjustment to the Fed shrinking its balance sheet along with Fed rate hikes, was fairly uncomfortable for EM. Another period, as I said earlier, and also mentioned in terms of introductions, was in 2013, what we called the Tabor tantrums. Well, those both periods, we had international ownership quite high, indeed historically high in those relevant points in most markets going into those, what I call the pull factors of the Federal Reserve. So these are the external impacts having an impact on the domestic markets. Now, how to view this? Yes, there's a lot of lines and colors here, but what this represents is the peaks and troughs or max and minimums of international ownership, foreign international ownership of local government debt. And the red represents the maximum since January 2015, and the gray represents the minimum. And the blue dots is where we are currently. And you can see a swathe of EM markets where there historically was at least cycle lows, not necessarily historical lows, but certainly cycle lows. And 2 barometers for me are regionally and globally because they represent a lot in terms of EM. It's Mexico and Indonesia. And you can see both those blue dots are on those cycle lows. And for example, Indonesia, we know prior to the pandemic, international ownership was something to the tune of nearly 40%. Foreign ownership is now dwindled to less than 20%. But again, I reverse engineer this. This is a contrary signal rather than a consensus signal in my mind. That means there's more opportunity for flows to come back in rather than another wave of flows going back out. 2 final points, and I'll mention it a little bit later. 2 countries are the opposite part of that. You may not see it too much because obviously the EM high yielders are much more important in terms of peaks and troughs and international ownership, but it's China and Korea. So if you can squint your eyes and see through the charts, you'll see actually the opposite case in China and Korea, where international ownership is at the highs, so the blue dots are at the top of the red bars. So we've seen what we call flight to quality and safe haven going into these markets, given the volatility in EM. Again, I'll turn to that a little bit later, but a little bit more broader, turning to the next slide, is if you look at the difference in terms of blues and reds. So this represents the low yielders and high yielders. Low yielders are the high rated sovereigns like China, like Korea. And this is a classic reaction function, and the gray bars represent event risk. And you can see that since the pandemic, there's been a huge appetite going into the low-yielding, high-rated sovereigns. So this is already sort of, even if it's a different ingredient, it may be not necessarily just about anticipating balance sheet shrinkage and Fed tightening, but there's already been a conservative positioning in the market. So that blues represents safe havens going into China and Korea in particular. And you can see at the outset of the pandemic, as per the regional charts, the red bar is high yield, and we saw a rump of selling at the early stages. So if we're right, after we get through the hurdle of the little bit of wobbles of the initial stages of Fed tightening, I do think there'll be some adjustments in terms of rotation out of the safe havens into some of these high-yielding markets, and in particular, as I mentioned, some countries like South Africa and Indonesia, to name a few. If you look at the next slide very quickly, just as one, because it's a similar sort of theme, you can see this again, more specifically on a quarterly basis. This time, the red bars are still the EM debt, but it's high yielders, and this is on a quarterly basis. And you can see, going back to that general chart I showed you earlier, that in reality, there hasn't been much appetite for EM high yielders. The black bars are the low yielders, have been fairly consistent. But again, I draw comfort for that as a contrary signal rather than the consensus signal. And if we look at the next slide, I think we also need to look at it on a regional basis. So if we look at the next slide, on a regional basis, you can see that yes, on EM, on aggregate, the top line, we've seen flows coming back in. That's, I think, misleading. Quite often, a lot of research just looks at generic numbers and says there's been flows going back into EM. Well, I've already showed you there's key distinctions in my lens between low yielders and high yielders. So a lot of this analysis is too generic in my mind. And then indeed, even that I think is too generic, because when you look on a regional basis, actually, when you start stripping out LATAM and CEMEA, and those are the individual lines at the bottom, you can see as Asia has been the most dominant focus as the return of flows in the debt markets. And again, specifically, it's actually been crowded out by China. So this is a little bit of reverse analysis in terms of looking at the numbers. But you can see this a little bit clearer, hence why I'm going a little bit quicker in the next slide. And you can see it quite clearly in terms of flows since January 2020. So in essence, since the outset of the pandemic, China government bonds, Korea government bonds, those have been the key recipients of the flows, the return. So I wouldn't say this has been strong appetite for EM. It's been very specific safe havens. At the opposite end of the spectrum, you can see India, Indonesia, and Mexico has been those outflows. But that's a story in the past. That's the rearview mirror. We want to look at the road ahead, and something that I'll paint a little bit shortly. But let me just very quickly go through the next slide. And I want to show you potential changes in one particular market. I concentrated heavily on China. It's been the rare market we've seen flows. Does this provide an element of sucking flows from other markets, including Indonesia, including South Africa, including others? Well, to a certain degree, yes. And I don't expect you to go through all these sequencing of events, but broadly speaking, China has been a key target for flow of funds, in particular because of interest rate differentials. We've had at one stage, China government bond yields 200 basis points over US treasuries over a year ago. And that led to diversification out of US debt into China, and also EM funds going into that particular market. Also indexation. We've had three indices, the GBIM, this is an EM local debt index, big behemoth of a global aggregate index, includes treasuries and other key markets in terms of Bloomberg Ag Index, or the WGBI, as we call it, the World Government Bond Index, the FTSE Russell, who leads that index, that has just been announced November last year, or indeed inclusion's been announced earlier, but inclusion of November of last year on ongoing. This has led to a flood of money going into China, and to a certain degree, there's been an element of cannibalization. So all those flows that you saw was very concentrated in Asia, concentrated in China, but we expect that to dwindle, not necessarily reverse course, but be less this year than last year. Indeed, last year we saw 90 billion inflows into China government bonds. It was 85 billion the previous year, but we think that pace will start to dwindle somewhat. Why? Because indexation issues are now getting completed, and also interest rate differentials. With the US Treasury yields rising, we've got less than 90 basis points cushion, and we think the easing path, yes, is still ongoing, but it's unlikely to be continuing for the rest of the year. So this is therefore looking to the road ahead rather than rearview mirror. There could be some rotation into other markets. And that leads us into the final two slides. And the last and penultimate slide is, sorry, let's go back just one more, thank you. The penultimate slide is this, and this is Indonesia. So very topical because it resonates with the EM high yielders. It's a regional barometer, a global barometer for me. And we can dissect some of this flow of funds more specifically now within Indonesia, and we can see what resonated last year and the years before, in particular in the right-hand side. Yes, we saw some disinvestment for foreign investors. Yes, we saw distinct demand replacing that in terms of both banks in particular, but also the central bank activity reverse schemes. But what I'm trying to show you is that there could be a case to be made, indeed we are making this case, where there's likely to be a rotation. So the management of flow of funds that we saw last year was not unique to just Indonesia, it was more of a broader theme. And I think the fundamentals, macro dynamics, point fairly favorably to Indonesia and other markets in terms of high yield. But let's conclude, but in particular, what are the takeaways from all this? Well, firstly, not all other risk asset classes are the same. One, we know there's been a huge distinction between equity in the US and also the USIG. You could argue that some of the gyrations we're seeing so far year to date is representing some of that heavy positioning in that asset class. Two, if you look at resilience of EMFX, if you look at resilience of bond market movements, indeed, we've seen bond yields in some EM markets fall so far this year when US Treasury yields have risen, suggesting macro dynamics are more supportive, that the positioning is also fairly encouraging. And in Indonesia, for example, also yields haven't moved as much as that of US Treasuries. But another reminder is not only are other risk asset classes different, as also we know in the EM there's a difference too. So let's look at the final slide and look at these returns within the lens of last year. And yes, it was a difficult period for EM returns last year. This looks at all the individual major markets in emerging markets in terms of local government debt, the returns. Most had negative returns, hence that number I showed you earlier about down 8%. But not all EM bond markets are the same. We know this, we live and breathe it. But China was the one that shined last year despite the heavy storms. But Indonesia too, in absolute terms and in Sharpe ratio terms. So in reality, there are differences in last year, and I think this year, when we get through the navigating in terms of flow of funds, EM exiting, or indeed, and also Fed exiting, we're better prepared, and that's why we're more constructive on EM this year than we are last year. So the key calls are South Africa and Indonesia, and then the low yielders a little bit more in terms of China and Korea. So I've spent enough on that time, and I'll hand back to Tommy.
All right, thank you, Mr. De Silva, for your presentation. So now I would like to invite everybody to put their questions in the chat box, and we have several already here, sir. So let me just invite Bapak or Mr. Mikael from Bank Indonesia. You raised your hands already. May the team open your audio there. Mr. Mikael, you're already on?
Yes, hello. Yeah, okay, already on. Thank you very much. Thank you very much, Mr. Andre De Silva. I got a couple of questions. The first one is, what factor will investor pay more attention to when investing in EM in 2022? Is it real yield or yield differential? And the second question is, in this current situation, from Fed point of view, which risk is bigger, too fast to raise or too slow to raise? Thank you very much.
Okay, I'll tackle the last question later because that's the more difficult one. But the first one, real yields. Yes, I do think this is part of that rainbow analogy, as I said earlier, in terms of one of the 7 colors. And it doesn't apply to all. There are a lot of question marks on the trajectory of inflation. But if you look currently in terms of real yields, the highest real yield at the moment is, no surprise, what I mentioned earlier, given our recommendations, is South Africa and Indonesia. But the problem with real yields, which is, I'm sure this is a broader audience, but some people may not know, it's looking at nominal bond yields, so let's say 10-year bond yields, and subtracting inflation, is where you take that inflation measure. Do you take the inflation measure as of now, or projection into 12 months' time? Of course, you would like to look at consensus or your own forecast in 12 months' time, but there's a lot of uncertainties. So we look at both real yields based on current CPI and real yields based on projected CPI. And both those circumstances, South Africa and Indonesia, shine out as a protection. So to me, it's real yields that matter more than nominal yields, because nominal yields is a more of some risk premium and protection. The second point, and again, doesn't apply to all. Just for completeness, for example, you've got very little protection in India. Let's stick to Asia, for example, when real yields are already very low and could be even lower, indeed even negative, depending on your inflationary outlook over the course of the next 12 months. Your final question, in terms of the Fed, that's a presentation in itself and a forum in terms of discussion point. Too slow or too fast. What does it mean for EM? Well, to me, I think what is necessary is clarity. Clarity and transparency is more important in this current environment. So we are waiting, and we still don't have the full clarity. We're getting a clear indication since December of last year about the Fed liftoff. It seems odds on that March will be a rate rise, etc. But we need clarity on the degree of tightening. Now, of course, the Fed will never divulge exactly the sequence, indeed, because it's data dependent, etc. But we're looking at the long-term dot plots, the terminal rates, and if that doesn't change, then I think EM will draw comfort that the Fed is raising rates, I wouldn't say early, but certainly starting off come March, and we get a sequence and we can see a path to the road to the end of that. In terms of being too late, yes, I think that's more of a problem, but I doubt that the FOMC will miss the opportunity to raise rates in February. The question, though, is the balance sheet. I think that's the next area of uncertainty, and we do need some clarity of the balance sheet and a clear prescription of when they are going to shrink the balance sheet and sort of what mechanical means. We had that in 2018, a quite clear path. This time we need that. So I think the focus for me now is more on the balance sheet and getting clarity in coming months than it is about the Fed hikes and whether it's behind the curve or ahead of the curve.
Thank you, Mr. De Silva. Mr. Sim, would you like to add something here?
Yes, just one point or maybe two about the question was on the interest differential. But to me, from investor point of view, investing in EM local currency, I guess FX return or volatility is hugely important. And I guess sharp ratio then also, that's true. So the question is, how much foreign investors believe that EM local currency exchange rate would remain stable this year, for example? I think that's going to be an important aspect. And another point, comparing with the taper tantrum, I guess the Fed has, since taper tantrum, I guess the previous two chairs made very clear that it's very important to communicate to the market in advance what the Fed wants to do. It's not only in the public domain, also in more, I would say, restricted within among central banks. A lot of effort going on by the Fed to tell in advance what's the plan. And to me, this is a big game changer. So this time, of course, we are waiting for a relatively steep tightening by the Fed. At the same time, the communication effort has been much, much different this time compared to the taper tantrum. So from EM point of view, that means there will be not that much truly surprise. So yeah, announcement, which would actually help the EMs you mentioned.
All right, thank you, Mr. Sim. And now we go to the next one, Bapak Nur Nugroho. Pak Nur Nugroho, you may open your audio and ask directly.
Thank you, Tommy. I have two questions. The first one goes to Mr. Da Silva. From your slides, you show that the global liquidity has started to decrease. And I guess it relates to the normalization by the developed market central banks, especially the Fed, that they have started the tapering, and they will start the Fed fund rate hikes by 4 times. And they also will follow with the balance sheet runoff. And as the impact, the flows to the emerging market bonds have decreased, especially in Mexico, India, and also Indonesia. And I think this is just the beginning. We are worried the outflow will be higher since market participants start to expect the Fed will hike the Fed fund rate more than 4 times. So my question is how to anticipate the shift to faster normalization, and what factor should be watched, because this is important for us. And I have one also question to Mr. Sim. It is interesting that your research that the exchange rates movement, especially the US dollar, affects the flows to the EM the bond as well as the yield. I'm just curious whether when you measure this, did you also control the idiosyncratic factors, especially the macroeconomic conditions? And the question is how these two factors affect the EM flows. And if you can more straightforward, which one is more dominant? Thank you. Thank you, Pak Chokro.
Thank you, Pak Nur. Mr. De Silva, you may answer the first question.
Okay, that was quite a detailed question, so let me try and decompose some of it, and forgive me if I miss something, but please interrupt and reiterate if I haven't covered everything. But let me, in particular, yes, I understand the anguish and uncertainty surrounding the Fed, and to be fair, this is not just about the Fed central bank balance sheet. We've seen a sequence of other, even if I did a global liquidity measure of the Fed, BOJ, and ECB, we could also put into that the RBNZ, which stopped QE in July of last year. Bank of Canada stopped QE come October last year, raising rates already. So there's been an exiting of a lot of G10 and others in terms of policy. So it is a coordinated element of withdrawal of liquidity. And also EM. Last year we saw, for example, Brazil raise rates over 725 basis points, Russia 425. So it's a collective exiting of policy, not just the Federal Reserve. But of course, we are all fixated on the Fed. It still matters the most. But I still wouldn't be too concerned about the path of rate rises. And actually, I think is a good thing if it anchors inflation expectations. It's orderly, it's transparent. As both myself and Mr. Sims agreed, transparency and clarity it matters a lot. And the market's already got over 4 rate rises. Indeed, it's now toying with the idea in terms of pricing, could be 4, could be 5, depending on which day you look at in terms of pricing. And next year, a sequencing around 3, etc. So to me, it's whether we break the terminal rates, as above 2% and more, and whether the Fed needs to catch up. That's the more of an issue, rather whether the Fed does 4 or 5 rate hikes this year. What to focus on, though, in terms of the measures, well, it's quite clear to me, and it is in terms of the Federal Reserve, and this is both EM, DM, but this is inflation, right? Inflation, that word transitory has now been dropped, and we're on tenterhooks rather than transitory in terms of inflationary numbers. And let's see what happens. I'm actually more comfortable in EM than DM on the inflation outlook. So again, there could be a divide with better preparation in EM in terms of central bank tightening. And when I say that, it's also about liquidity measures. So we know the Bank of Indonesia has done the good orderly thing, in my mind, for market investors, is by giving a sequence of guidance of RRR hikes over coming months. And other central banks have either raised rates as well and reduced liquidity, is what happens to inflation. And I think there's a greater case to be made in EM where food inflation is already peaking. If you look at the Baltic Dry Index, for example, the supply bottlenecks, you can see that declining fairly rapidly. Look at China PPI, etc. One niggling, and it's a big niggle, is oil prices, of course. But I'm more convinced that the EM inflation cycle is peaking. But for DM, what is critical, and this is where the Fed reaction function and uncertainty about the lift-off and balance sheet shrinkage, is whether we get an escalation of further inflationary pressures. Now, I'm comfortable on the sort of base effects, the food components, but for the US, it's like rent prices, wage inflation, and whether we get a structural break from the low inflation that we saw for decades over the past 10, 20, 30, indeed 40 years. This is the crux of the issue. And I'd look at that. The final one, and it goes to introductions back to Mr. Sim, who'll answer your question. I also think foreign exchange. How it reacts to these things. As I said earlier, it's more than a coincidence that EMFX has been fairly resilient, even if the dollar has appreciated against versus other major currencies, in particular the euro year to date. That really hasn't been the case in terms of EMFX. So as long as EMFX becomes quite well behaved, then the reaction function in my world in terms of local debt, because it's the whole complex, would be comforting. So at the moment, it suggests we are prepared, carry considerations matter, and we shouldn't be less concerned. We shouldn't be as concerned as some people are, at least in terms of the Federal Reserve. Over to you, Mr. Sim.
All right, thank you, Mr. De Silva. Okay, Mr. Sim, you may answer the second one.
Thank you. Yep, the second question, yes. So in the presentation, I actually didn't spend any time, but when I was saying with controls in some directions, it was including VIX as what you can call traditional global factor, and US CPI, IP, and also money market rate, and also EM, recipient country CPI, IP, and money market rate. So I think it's all controlled. So, and yeah, the control doesn't actually change a lot of the stories. So what I showed you are quite robust. But the second question is more interesting. So you're basically asking what's more important, sending country or global factor versus the recipient country factor. And the exercise of the US dollar index versus bilateral is sort of a glimpse of that. So I was already showing that the global factors, you can call the dollar index as one global factor, then that seems to be quite powerful compared to bilateral exchange rate. So here the important is I'm basically looking at the same exchange rate, the metric we're comparing. And I did another paper a few years ago measuring the US sort of a sending country CDS spread versus recipient country CDS spread, and which one is more important in driving the capital outflows from EM. And it is, in general, the sending country CDS. So the main story was sending country banks, when they face their own headquarters country CDS spread moves, and they tend to withdraw more than the recipient country. So the BIS as an institution, we are paying a lot of attention to this question. And many emerging Asia central banks actually agree that the global factor seems to be more dominant nowadays than the local factors. When you ask the same question to Latin American central banks, they may say slightly different answers. So depending on which EM, and my story goes back to the importance of fundamentals. So if EM has very strong fundamentals, the market believes that they tend to sort of make these local factors less important. But global factors are a completely different story. Let me stop here. Thank you.
All right, thank you, Mr. Sim. And now I would like to invite Mr. Nicolaus Gary. Pak Nicholas, Pak Gary, silakan.
Yes, thank you for the opportunity and thank you for the excellent presentation. In this current DM market policy normalization trend and potential slowdown in China, as we know, PBOC already loosened up their tightening policy. In EM Asia, who will be more favorable and who will be less favorable in this current condition from the foreign investor point of view? And the second thing, current rising geopolitical tension in Eastern Europe between US and their ally with versus Russia, will it be the black swan event of the 2022? And how's the impact to the EM Asia? Because as we know, ECB already warned the bank in the Europe area regarding that risk. Thank you so much.
Okay, Mr. De Silva.
Thank you very much. Again, quite a lot in that question, but let me just look towards Asia. So who is more resilient? who is actually could actually benefit in terms of decoupling and who is more exposed effectively in Asia. Well, you already mentioned this earlier, Nicholas, in terms of the divergence in policy in terms of PBOC. As you saw on my last slide, you saw actually it was one of the rare markets that performed in absolute terms and Sharpe ratio terms in terms of local debt last year. We continue to expect that at the early stages of this year, and already moved from stealth easing to outright interest rate cuts. Indeed, the last time those interest rate cuts was surrounding the pandemic, early stages in March 2020, and more to come. So with that divergence in interest rate policy, that should still underpin China government bonds. But let's not get too far. I don't think it is as distinct as last year. One, because interest rate differential, two, indexation issues, and I don't think monetary policy will be the only vehicle. It could and likely to be so more fiscal at some stage, and that may have some impact in terms of returns later into the year. But certainly heading into a Fed hike, let's assume it's in March, and that's our official view from HSBC, then certainly China government bonds are the more resilient and could and still decouple. The other ones, let's concentrate on the high yielding markets. To me, it's between the two eyes, and forgive me for the sort of general phrase for that, but it's Indonesia and India. Again, irrespective of this call, independently, we have our own research, and we do think Indonesia is better prepared than that of India. Not just because of past returns, not because of Indonesia's just managed to avoid the repercussions of net outflows in terms of foreign positioning, but because of the macro dynamics and all the questions I had earlier about real yields. And also including in terms of already effectively, I wouldn't call it policy liftoff, but guidance in terms of reducing of liquidity much more than the example of India. And then if you look at the two contrasting markets in terms of inflation, at the current juncture, we're still waiting for January inflation for Indonesia, but the current juncture inflation has been below the central bank target and consistently below even during the pressure period points for EM all of last year. And it's still likely and well behaved. The opposite case for India has been above target consistently and has yet to really exit in terms of policy. So to me, you've got the three layers of traffic lights in terms of certainly go for China in the short term, the amber relative to last year and potentially going to green is Indonesia, but the red is still India because of inflation pressures, little margin in terms of real yields. So that was the question on Asia. So very briefly on event risks surrounding geopolitical risks, let's call it that. I'm not going to go through too much detail. We're already familiar with headlines in terms of Russia, whether it be invasion, incursion, and sanction risk. But let's look what's already happened. So year to date, the largest sell-off in EM bond markets in terms of 10-year government bonds, no surprise, is Russia. And it's nothing to do with the Fed balance sheet and preparation. This is clearly what we call idiosyncratic risk. Whereas other bond markets have been very resilient. China bond yields have fallen. Indonesia bond yields haven't moved much, and neither has South Africa. Actually, they've dropped, and Mexico very limited. So at this current juncture, I still don't think there's necessarily contagion. I'm familiar with the phrase black swan. Indeed, I'm studying it at Oxford University. I'm doing a master's part-time, and Taleb is the author of the black swan. He doesn't call, for example, the pandemic a black swan. He calls it a white swan. I think Russia would be a white swan too. It's a known unknown entity, i.e. we don't know whether it's going to be in terms of incursion, but we already know some of the events, and that's being priced in. The quick conclusion would be it really only has a bearing for me in terms of EM. Of course, it has an impact on idiosyncratic risks and those asset classes that are directly involved, like Russia. But for other EM, it's if it has a global ramifications, if there's a distinct risk off, if all risk asset classes sold off, not because of just the Federal Reserve, but because of distinct factors within Russia and elsewhere, then yes. But in the current course where we see, I'm less concerned about that. It's more about the more macro issues about the Fed and central bank tightening than it is about the event risk surrounding Russia.
All right, thank you, Mr. De Silva. Mr. Sim, would you like to add something here?
Not much actually, especially I'm probably not gonna mention specific countries in the context, but what's in addition to what I mentioned before, I guess what's more important also in this juncture in terms of differentiating countries among the EMs is the what I can call policy buffers, especially fiscal space. It's very important, and still we are in the middle of the COVID phase, and that means there may be some need to do more. And once countries have higher debt, either private or public sector, and then you are pressured to raise interest rate, then you can imagine there are a lot of concerns about the debt payment burden and the implication for macro and so on and so forth. And that's going to be additional sort of challenge for the EMs with high level of debt. And I guess that sense it's going to be a difficult sort of game situation for those EMs with a high level of debt.
Right, thank you, Mr. Sim. And allow me to read one last questions from Bapak or Mr. Colby from Bank Permata. What is implication of Fed tightening policy to emerging market, considering a record low of foreign ownership of bond in high-yield emerging market countries? Will it more severe than taper tantrum, or will it be more tame? Mr. De Silva?
Right. So this is almost a summary, and it's a good question to end. It's a summary of our discussion. Whether you look at the precedent of 2013, which was the taper tensions, whether you look at QT, as I call it, quantitative tightening of 2018, whether we get a rerun or even more so in terms of repercussions for EM. Well, already, as I alluded to earlier, the positioning, and as per Mr. Kobe's question, international ownership has dwindled dramatically, and that was completely different, in particular 2013. I remember distinctly in the repercussions of the global financial crisis, we then had QE, which again was allegedly called a black swan event, and we had a lot of flow of funds going into not only equities and developed markets, but at that stage also EM, and in particular retail. In terms of analysis, I'm sure Mr. Sim's gone through this data as well. Not only just aggregate flows, we saw mutual fund flows going to the EM distinctly into that asset class, and there was a huge shakeout as a consequence. This time around, it's been more institutional, and it's also been net liquidation in preparation well in advance of whether you call it QT and certainly a hawkish Fed. So in my mind, it's going to be, I wouldn't call it tepid, but I think it's going to be very resilient. I know I'm trying to think of another T word as a resilient, but I think it's going to be resilient in various guises. But I do think, going back to the point earlier, both the foreign exchange matters, but also fiscal positioning too. And I draw comfort in some countries where you're already beginning to see fiscal consolidation. And so there's coordination between the central bank and government, knowing that it's not just about preparing in terms of monetary policy cycle, but it's also getting fiscal discipline back on track relative to the pandemic. And lo and behold, independently, I would say Indonesia is doing that, as you can see in terms of the projections of the deficit coming down relative to original projections. It's very rare in EM. So it's more exposed to other markets than in the case of Indonesia.
All right, thank you. And Mr. Sim?
Yes, I guess the taper tension versus now, I already covered that part. So just focusing on capital inflow or lower level of foreign participation by now. And this is true. I mean, it has been sort of outflow. At the same time, you can think about the sort of EM fundamentals has improved. At the same time, it became sort of lower. The EMs were able to lower rates over the past 3 years. Now they're about to increase. So what does that mean is, again, like the risk return characteristics. The volatility was there, but the return was lower, and EM was able to weather the crisis. And at the same time, a lot of hype on US equity, other equities, more risky assets. So this is sort of a time that, relatively speaking, EM local currency bond may look less attractive, but that doesn't mean that there's a fundamental issue. I don't think this is the case. And as I said, class is sort of a medium risk asset class by now, I guess overall EM compared to more risky other asset classes coming up. So things will change, and I have quite confidence that this is sort of a time, maybe a low point, but doesn't mean that asset class is going to lose interest. A lot of interest for, especially not necessarily bond funds, which is more volatile, for more longer-term investors. As long as fundamentals are good in EM, there must be, and there has been strong interest. So I think it's going to continue.
All right. Again, thank you. And that concludes the Q&A. Thank you, Mr. Ilyok Sim, Mr. Andre De Silva, and also all the participants who had time to ask questions, Mr. Mikhail, Mr. Nur Nugroho, Mr. Nicholas Gary, and Mr. Colby. And again, let's give a warm applause virtually to all speakers and also all the participants who asked questions. And we would like to apologize that we cannot put all the questions and give the answers right now in terms of time and duration. And allow me to summarize a little bit. So based on empirical studies, policy normalization by major central banks will impact emerging market economies through interest rates and exchange rate channel. So it is crucial for emerging markets to monitor FX and asset price development, signs of dollar funding strains and commodities price amid the exit phase. But most Asian emerging market economies now have better fundamentals and institutional strengths. Financial authorities in the emerging market have also demonstrated a good job in safeguarding domestic financial stability and external stability, but it is also needed a joint use of policy tools during COVID-19 pandemic. And from HSBC, from Mr. De Silva, faster Fed rate increases in response could rattle financial markets and tighten financial conditions globally. And this development could come with a slowing US demand and trade and may lead to capital outflows and currency depreciation in emerging markets. But the fund flows to emerging markets have already rolled over on the back of less supportive liquidity. And in the same time, emerging market rates have been more ready to deal with Fed rate hike cycle. Emerging markets can take steps now to strengthen policy frameworks and reduce vulnerabilities, and for central banks implementing strategic policies to contain inflation pressures. Clear and consistent communication of policy plans can enhance the public understanding of the need to pursue price stability. So Governor Perry mentioned on the first day, life is full of challenges. After a rough period due to the pandemic, policy normalization is one of the known risks that emerging markets have to face in 2022. From the discussion today, we can conclude that despite the rate hikes by major central banks, emerging market is expected to be more ready and remain attractive for foreign investors. The BI policy mix in 2022 will remain synergized as part of the national economic policy direction to accelerate recovery while maintaining economic stability. Again, thank you to all participants for the questions and all the speakers. And again, stay cautious and optimistic, productive, and of course, stay safe. May we all bless with a great health. Again, thank you. And now back to you, Mr. Imade Arta Segara.
Thank you very much, Mr. Ilyok Sim, Mr. Andre De Silva, and Mr. Tommy Chokro for an enlightening view and thoughtful discussion. To conclude the discussion, we would like to invite Mrs. Dwi Safarina, Group Head of Bank Indonesia's Reserve Management Department, to give her closing remarks. Mrs. Dwi Safarina, the stage is yours.
Assalamualaikum warahmatullahi wabarakatuh. Good morning to our esteemed speakers, Mr. Ilyok Sim from BIS and Mr. Andre De Silva from HSBC. our excellent moderator today, Mr. Tommy Chokro, distinguished guests and participants. Ladies and gentlemen, we have reached the end of the International Seminar Exit Strategy, which is also the last event of the Bank Indonesia Annual Investment Forum 2022, start from January 27. It is a privilege and an honor for me to provide closing remark for today International Seminar, which is also a side event of G20 Presidency of Indonesia to 2022. I would like to express my gratitude to all the speakers for your enlightening presentation that are important for participants to face challenge in 2022 with optimism. I would like also to thank all for active discussion throughout the day. It is a day full of information, insight, and ideas which are useful to make a decision better. Ladies and gentlemen, as we have discussion today, we are entering 2022 with expectation to continue recovery after 2 years COVID-19 pandemic, supported by the improvement of rollout of COVID-19 vaccine in large part of the world that has been successfully reducing the severity of COVID cases. Even though current conditions are still risky and global economic growth is expected to be slower than 2022 due to spread of the Omicron variant, we still have good reason to maintain optimism that economic recovery will continue. Due to vaccination rates and how bad the impact of the pandemic, recovery around the globe is expected to be diverse, in particular between advanced and emerging markets, depending. In fact, for some countries, the recovery process has led to a spike in inflation stemming from higher wages due to labor shortage and increased domestic demand. As for the others, inflation is triggered by rising energy prices and supply chain bottlenecks, which are considered to be temporary. The situation will be nonetheless lead central bank and authorities to react in different manners. Ladies and gentlemen, the Fed has recently signaled faster tapering to normalize policies during COVID-19 pandemic earlier and start shrinking the balance sheet by end of 2022. And not only the Fed, several central banks in major advanced economy and some emerging market countries in Latin America and Eastern Europe have also started their normalization as well. However, some countries are still maintaining accommodative stand due to benign inflation and scaring effect of COVID-19 pandemic. This kind of mixed and different pace of normalization will affect global capital flows. Different than in 2013, when we were experiencing taper tantrum, the coming Fed tapering and rate hike are expected to have benign impact in financial market and on the emerging market due to improvement in fundamentals. Both our speakers today seem to agree with this view. Interestingly, Asia in particular is viewed to be better positioned than other EM regions. Asian central banks stay more prudent in normalizing monetary policy due to stronger external balance in most countries, supported by more subdued inflation pressure, and the region is less impacted by supply chain disruption. Currently, more EM central banks already have sound policy framework combining inflation targeting framework with foreign reserve accumulation and macroprudential tools to deal with capital flows and exchange rate dynamic. This policy mix help some EM countries to maintain stable financial system in the midst of COVID-19 pandemic, especially for countries to have benign inflation expectation and ample reserves. Ladies and gentlemen, the road to recovery could be a little rocky and watery. There are still various downside risks that could weigh the outlook. other possible COVID-19 new variant, food supply disruption, financial burden, and climate change could be some distress. Some countries may deal with this risk better than others, but some countries could be risk of hard landing. Global collaboration and promote by G20 nation could be offer effective solution to create more resilient and stronger global economy in weathering the pandemic. Ladies and gentlemen, thank you for participating in Bank Indonesia International Seminar on Exit Strategy, a side event of G20 Presidency of Indonesia 2022. I hope you find today's event interesting, useful, and bring optimism toward continued recovery in 2022 regardless challenge ahead. I wish for the future prosperity of all the participating colleagues and organizations, and may the world be better for all of us. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you very much, Mrs. Dwi Safarina. Now, we have arrived at the end of our Bank Indonesia Annual Investment Forum 2022. On behalf of the organizing committee, we would like to thank all the speakers, moderators, and discussants for delivering such a valuable insight. Thank you for your participation in this forum. And for all the participants, we would like to extend our deepest appreciation to you for your support and engagement throughout the 3 days event. Last but not least, we would like to remind you that we have a series of 2022 G20 Indonesia side events, and the closer ones are in this February. In line with this, we would like to ask your kind participation in supporting the continuity of the agenda. Once again, thank you. We wish you all a pleasant day ahead, and see you in Bank Indonesia Annual Investment Forum 2023.